You earn a decent salary. Your paycheck is bigger than it was 5 years ago. And somehow, by the end of the month, the money is gone. That does not automatically mean you are irresponsible. It may mean your household is caught inside 7 financial traps that have become especially expensive in 2026. These traps do not look like luxury. They look like normal American life. A mortgage, a reliable car, a credit card, health insurance, a retirement account. Each one can be reasonable by itself. The problem begins when several of them quietly claim the same dollar before you have a chance to save it. That is why a household can earn $90, $120, or even more, and still feel one repair, one medical bill, or one layoff away from panic. So let us count down the 7 money traps squeezing middle-class Americans in 2026. Explain why they are dangerous, and identify what would make each warning less serious. Number 7 is lifestyle inflation disguised as necessity. Lifestyle inflation means your spending rises whenever your income rises. You receive a raise, but instead of creating more financial breathing room, the raise gets absorbed into a more expensive apartment, a newer vehicle, additional subscriptions, restaurant delivery, children's activities, and upgraded vacations. None of these purchases has to be absurd. That is what makes the trap effective. A family does not usually wake up and decide to destroy its savings rate. It makes 10 separate decisions that each seem manageable. Another $80 here, another $140 there. A monthly payment instead of a full price. Soon, a raise that should have added $500 a month to savings has created $650 a month of permanent obligations. The key word is permanent. A restaurant meal ends tonight. A financed car, larger mortgage, private school commitment, or expensive lease follows you for years. Behavioral economist Daniel Kahneman helped explain why this happens. People adapt quickly to improvements. What felt like an upgrade 6 months ago becomes the new minimum. Economists call part of this hedonic adaptation. In plain English, your brain gets used to nicer things faster than your bank account recovers from paying for them. The indicator to watch is not your salary. It is your savings rate after every raise. If income rises by 5% and savings do not rise at all, your lifestyle may be consuming every improvement. This warning could be overstated for households whose spending rose because of childcare, healthcare, elder care, or another unavoidable need. Not every increase is careless. But, before turning a raise into a new recurring bill, ask one question. Will this purchase still feel affordable if my next raise does not arrive? Number 6 is the oversized vehicle payment. The American auto market has trained buyers to focus on the monthly payment rather than the total cost. That is convenient for the seller. It is not always convenient for you. A longer loan can make an expensive truck, SUV, or luxury vehicle appear affordable. But stretching the loan does not lower the price. It increases the time you pay interest and raises the risk that you owe more than the vehicle is worth. That condition is called negative equity. Negative equity means the loan balance is larger than the car's resale value. If the vehicle is totaled, becomes unreliable, or needs to be sold after a job loss, the owner may have to bring cash just to escape the loan. Then there are the costs that never appear in the advertised payment. Insurance, registration, fuel, tires, maintenance, parking, and depreciation. Depreciation is the loss of value as the vehicle ages. It is usually the largest ownership cost, even though no bill arrives in the mail labeled depreciation. A $900 payment is not merely $900 when the insurance premium, gasoline, and maintenance push the real monthly transportation cost far higher. The trap is worst for a household that needs 2 vehicles and finances both. The indicator to monitor is your total transportation cost as a percentage of take-home pay, not just the loan payment. A newer vehicle may remain a rational choice for a long commute, a business, disability access, family size, or reliability needs. A low-rate loan may also preserve useful cash. But ask this before signing. Am I buying transportation, or am I financing identity? Number 5 is the house that makes you look wealthy and keeps you cash poor. Homeownership can build long-term wealth. It can also consume nearly every flexible dollar in your budget. The mortgage is only the entry fee. Property taxes can rise. Homeowners insurance can rise. Association dues can rise. Roofs, heating systems, plumbing, appliances, and foundations do not care that your checking account had other plans. In July 2026, the average U.S. 30-year fixed mortgage rate remained around the mid-6% range. At the same time, home prices in many markets remained high. That combination matters because the payment on the same loan amount can be dramatically larger than it was during the ultra-low rate period. Consider a household borrowing $400 at 3%. The principal and interest payment is roughly $686 a month. At 6.5%, it is roughly $2528. That is more than $800 every month before taxes, insurance, maintenance, or association fees. The danger is not that every home is a bad investment. The danger is assuming rising property value will solve a monthly cash flow problem. Home equity is the value of the home minus the debt against it. It can make you wealthier on paper while remaining difficult and expensive to access. To use it, you usually have to sell, refinance, or borrow against the house. That is not the same as cash in an emergency fund. The indicator to watch is your all-in housing cost, including a realistic maintenance reserve. The warning may not apply as strongly to an owner with a low fixed-rate mortgage, stable taxes, adequate savings, and plans to remain for many years. But before buying more house, ask this. If the home stops appreciating for 5 years, does the monthly payment still make sense? Number 4 is revolving credit card debt used as an income supplement. A credit card is a payment tool. It becomes a wealth destruction tool when the balance revolves from one month to the next at an interest rate above 20%. Revolving means you do not pay the full statement balance. So part of the debt carries forward and continues generating interest. In 2026, typical credit card rates remain near historically high levels. That means a balance can grow even while the borrower makes regular payments. Suppose you carry $10,000 at 22% and stop adding new purchases. Interest alone begins near $183 a month. If your payment is $250, only about $67 reduces the principal at the start. That is not a repayment plan. That is a subscription to your previous spending. The trap becomes more dangerous when cards are used for groceries, utilities, or medical bills because income no longer covers the household's normal operating costs. The card hides the deficit temporarily, but the interest makes the next month harder. Economist Hyman Minsky argued that financial systems become fragile when borrowers increasingly depend on new financing. To meet existing obligations, a household can experience the same pattern on a smaller scale. The indicator to watch is whether your card balance falls every month without relying on a tax refund or bonus. A balance transfer, temporary emergency, or strategic use of a 0% promotion can be manageable if there is a specific payoff date and no new debt. But ask this before swiping. Am I borrowing for a one-time problem or financing a monthly budget that no longer works? Number 3 is insurance that is expensive, incomplete, or both. Middle-class households often experience insurance as a confusing collection of premiums, deductibles, exclusions, and surprise increases. You may pay more and still carry more risk. A deductible is the amount you must pay before insurance begins covering eligible costs. A policy with a low premium and a very high deductible may look affordable until you actually need it. This affects health insurance, homeowners insurance, auto insurance, disability coverage, and sometimes life insurance. The most dangerous gap is often not a damaged phone or scratched car. It's the loss of income. Your ability to earn is probably your household's largest financial asset. Yet many people insure the vehicle that takes them to work more carefully than the paycheck the work produces. Healthcare creates a second squeeze. Premiums leave the paycheck every month, while deductibles, copays, prescriptions, and out-of-network charges can still create a large cash demand. The indicator to monitor is your maximum realistic out-of-pocket exposure across all major policies. Do not just ask what the premium costs. Ask how much cash the household would need after a serious accident, hospitalization, storm, lawsuit, or disability. Higher deductibles can be sensible when a household has a strong emergency fund. Lower coverage may also be reasonable for risks you can comfortably absorb. But ask this: which financial disaster would my current policies fail to cover? Number 2 is saving for retirement while carrying toxic debt and no emergency cash. This sounds responsible. That is why it belongs near the top. Contributing to a 401 can be one of the strongest wealth-building habits available to an American worker, especially when an employer provides a match. But a household can invest for age 65 while remaining financially unstable next Tuesday. Imagine contributing aggressively to a retirement account while carrying a credit card at 22% and having only $500 in cash. When the car needs a repair, the card balance grows again. The household receives a possible long-term market return while paying a nearly guaranteed high-interest cost today. That does not mean you should automatically stop retirement contributions. An employer match may be extremely valuable. Taxes matter. Age matters. Job stability matters. The interest rate and type of debt matter. The trap is treating every financial goal as if it has the same priority. Liquidity is your ability to access money quickly without taking a major loss or penalty. A 401k is valuable, but it is not designed to pay tomorrow's rent, deductible, or furnace repair. John Bogle built his investing philosophy around low costs, diversification, and long-term discipline. But long-term investing works best when short-term emergencies do not repeatedly force you into expensive debt or untimely withdrawals. The indicator to watch is the gap between liquid savings and your next likely financial shock. This warning is weaker for a household with stable income, low interest debt, excellent insurance, and access to other cash reserves. But ask this: am I building retirement wealth? Or am I using retirement contributions to feel secure while my present-day finances remain fragile? And number one is the monthly payment economy. This trap connects nearly everything else. Cars are sold by the month. Phones are sold by the month. Furniture is sold by the month. Vacations can be split into payments. Software, entertainment, food delivery, storage, security, fitness, education, and shopping memberships all arrive as recurring charges. Buy now, pay later services make the process feel even smaller. 4 payments appear easier than one price, but dividing a cost does not reduce it. The monthly payment economy changes the question in your mind from, is this worth the total price? To, can I survive another $1.49 this month? That is a much lower standard. The danger is commitment stacking. One payment is harmless. 25 payments can eliminate your ability to adapt. Then inflation raises groceries, utilities, insurance, and services. Your employer does not raise your paycheck at the same speed. Suddenly, the optional commitments are competing with necessities. The indicator to monitor is fixed cost rigidity. Fixed cost rigidity means the percentage of take-home pay already promised before the month begins. Include housing, debt minimums, car payments, subscriptions, insurance, childcare, and any installment plan. The higher that percentage becomes, the less freedom you have to respond to inflation, unemployment, or a family emergency. Some monthly services provide genuine value. Financing can also be rational when it preserves liquidity and the interest cost is low. But before accepting another payment, ask the most important question in this video. How much of next month's paycheck have I already spent? These 7 traps are not 7 separate failures. They form one system. The expensive house requires stable income. The expensive vehicle reduces emergency saving. The weak emergency fund pushes repairs onto a credit card. The card interest reduces retirement flexibility. The insurance deductible creates another balance. And monthly subscriptions make every paycheck feel smaller before it arrives. The solution is not panic, it is visibility. Calculate your fixed monthly commitments. Calculate the interest rates on every debt. Calculate your full housing and transportation costs. Estimate the cash required for your largest insurance deductible. Then decide which obligation is stealing the most flexibility for the least value. Middle-class wealth is not defined only by income, home value, or the size of a 401k. It is also defined by margin. Margin is the space between what you earn and what you are required to pay. That space buys time after a layoff. It pays a deductible without debt. It allows you to wait through a market decline instead of selling investments at the fall. Worst moment, it gives you the power to say no. You may earn more than you did 5 years ago. Your accounts may look more sophisticated. Your life may look more successful. But if every dollar already belongs to a lender, insurer, subscription, or monthly payment, the money is not really gone by accident. It was promised before it arrived. This content is for education and general information, not personalized financial, tax, or legal advice. Your best decision depends on your income stability, debt costs, taxes, insurance, time horizon, and personal circumstances.